Welcome to The Explainer. Today, we're going to talk about this huge glitch in the financial world. It's a puzzle, really, that takes one of the most basic rules of investing and just flips it completely on its head. All right, so let's just jump right in with a question that, we're all taught from day one. If you want a higher return on your money, you gotta take on more risk. Simple as that. That's the deal, right? I mean, it just sounds obvious. Well, the big theory in finance, the capital asset pricing model, or CAP, it says, yep, absolutely. It predicts this really clean upward sloping line, just like the one on the left. More risk should mean more reward. But, and this is a big but, when researchers actually dug into almost 100 years of real-world stock market data, the picture wasn't just a little different. It was shockingly flat. And look, this isn't some hot-off-the-press discovery. Economists actually first noticed this weirdness all the way back in 1972. What's different now, though, is the sheer mountain of evidence we've built up. It shows this isn't just some tiny crack in the theory. No, this rule is just fundamentally broken. Okay, so this chart, this really gets to the heart of it. When we sort stocks by how risky they are, and in finance we call that beta, the results are just, wow, they're astonishing. Once you adjust for risk, the safest stocks, the ones with low beta, they gave you really strong positive returns. But the riskiest ones, the high beta stocks, get this. They actually delivered negative returns on a risk-adjusted basis. I mean, think about that. You took on way more risk for a worse outcome. So, the Sharpe ratio. Think of it as your bang for your buck in investing. It's basically asking, how much return did I get for every unit of risk I took? And just look at these numbers. The safest stocks, they give you a fantastic ratio of 0.70. But as you start moving into the riskier stuff, that ratio just craters. It plummets all the way down to 0.28. You are consistently, and I mean consistently, getting less reward the more risk you take on. And here's the kicker. This isn't just some weird thing happening in the US stock market. Oh no. Researchers found this exact same pattern pretty much everywhere they looked. We're talking 18 out of 19 international markets, plus US Treasury bonds, corporate bonds, even futures markets. When a rule is this consistently broken across basically the entire globe, you just have to ask, what on earth is going on here?
Well, it turns out the explanation lies in one of the most powerful and often misunderstood forces in all of finance: leverage.
So here's the deal. A lot of the biggest players out there, I'm talking about the mutual funds managing your 401k or those huge pension funds, they're what we call constrained. They have all these rules that either flat out forbid them from borrowing money to invest or at least make it super, super difficult. So you can see how this creates a huge dilemma, right? Just imagine you're a fund manager. You have to hit a certain return target, say 8%, to keep your clients happy. But, and this is key, you're not allowed to borrow money to juice your returns. What's your only other move? Well, you're pretty much forced to buy assets that are just inherently riskier. You have to load up on those high beta stocks. And we're not talking about just one or two funds doing this. It's like a market-wide traffic jam. You've got all these constrained investors, all of them forced to chase the exact same pool of risky high beta assets. So what happens? All that demand bids up their prices way too high. And one of the most basic rules of investing is if you overpay for an asset today, you're pretty much guaranteed to get a lower return from it tomorrow. Okay, but here's where things get really interesting. If all of these constrained investors are being forced into the same kind of bad trade, well, that creates a massive opportunity for anyone who isn't constrained. They can just take the other side of that bet. And that, right there, is the entire idea behind a strategy called betting against beta. The strategy itself is just beautiful. It's so elegant. You literally do the exact opposite of what those constrained investors are forced to do. Step 1. You buy the safe, boring, low beta assets, and then you apply your own leverage to magnify their returns. And at the exact same time, you short sell all those risky, overpriced, high beta assets. You're basically making a bet that their prices are going to come back down to earth. So, does it work? Oh yeah. The performance is staggering. Between 1926 and 2012, this one strategy produced a Sharpe ratio of 0.78. Now, to give you some context for that number, that is nearly double the performance of the very famous value investing strategy. That is a huge deal. It's seriously one of the most powerful and consistent findings in all of modern finance. Okay, so if this is a real thing, and it works this well, are the actual players in the real world on each side of this trade? Well, the paper gives us a surprisingly clear picture. So, on one side of the ring, you've got the constrained folks. And just like the theory predicted, the data shows that mutual funds and individual investors, everyday people, they tend to own portfolios jam-packed with those riskier, high beta stocks. And on the other side, you've got the unconstrained players. We're talking sophisticated leverage buyout funds that specifically go after safe companies. And of course, the most famous example of all, Warren Buffett's Berkshire Hathaway. I mean, this is it. This is the ultimate real-world proof. The paper literally concludes that one of the most successful investors in history built his entire legendary career by systematically taking advantage of this exact market glitch. He bought safe, stable companies and applied his own leverage. So, let's wrap this up. The really crucial takeaway here is that one of the very first rules we all learn about finance, it kind of looks like it's a myth. And it's a myth that exists because of these real-world constraints, which in turn creates this massive, persistent glitch in the market. And for those who understand how the game is really played, that glitch is a huge opportunity. And all of this really leaves us with one final, pretty provocative thought. If a concept that seems so simple, so fundamental, like more risk means more reward, is actually this broken in the real world, it kind of makes you wonder, doesn't it? What other core assumptions that we have about how markets work might be completely wrong too?